All right. Time to crack open this real estate investment textbook. A classic. I'm curious to see what we can learn from it today.
Yeah.
The goal is to give everybody listening kind of a cheat sheet to real estate investment, to the core principles, strategies, the things to watch out for.
It's interesting because so many people are drawn to real estate
Yeah.
because it feels tangible,
Right.
more real than stocks or bonds.
Totally.
You can see it, touch it. It's not just numbers on a screen.
There's something grounding about it.
Yeah.
Owning an actual asset, and this textbook really digs into that appeal
Uh-huh.
right from the start.
Yeah.
It breaks down why people invest in real estate,
Yeah.
preserving capital, hedging against inflation,
Right.
generating all those motivators.
Yeah.
But what I found interesting was the emphasis on leverage.
Ah, yes. Leverage, that's where real estate can really shine,
Yeah.
but also where things can get a little dicey,
Okay.
is the idea that you can control an asset that's worth far more than your initial investment. Imagine buying a property worth $500,000
Yeah.
with a 20% down payment.
Okay.
That's just $100,000 of your own money.
Right.
And suddenly, you're in the game with a $500,000 asset.
That's incredible when you think about it.
Yeah, it is.
But as you said, there's risk involved.
For sure.
Like a double-edged sword.
Yeah,
Leverage can amplify your gains, but it can also magnify your losses
exactly.
if things go south.
Yeah, and that's why this book really emphasizes thorough due diligence.
Right.
It's not enough to just fall in love with the property.
Sure.
You need to analyze the market, understand the financials, really dig into the details.
Yeah.
Speaking of details, the textbook dives into these unique characteristics of real estate.
Yeah.
Things like
Okay.
fixity. I found that really interesting.
Fixity. Okay, I have to admit that one went over my head a bit.
Oh, yeah.
What exactly does that mean, and why does it matter for an investor?
Yeah, it's actually quite simple, but it has big implications. Okay, fixity basically means that real estate is fixed in its location.
Okay.
You can't just pick up a building and move it
Right.
if the neighborhood starts to decline.
Right.
Unlike, say, a stock portfolio that you can easily rebalance.
That makes sense.
Right.
So if I invest in a property in a neighborhood that's on the upswing,
Yeah.
that fixity could work in my favor.
Yeah.
But if the area takes a downturn, I'm stuck with that location.
Yeah.
And the value of my investment could plummet.
Precisely.
Okay.
And it highlights how location is paramount in real estate.
Yeah.
But the book takes it a step further and explains how even within a specific location,
Okay.
value is subjective
Okay.
and tied to market dynamics.
Right.
It's not just about the bricks and mortar.
Yeah.
It's about perception and those all-important forces of supply and demand.
It's kind of like this dance,
Yeah.
how a seller perceives the value of their property,
Uh-huh.
often influenced by emotional attachment. But then you have potential buyers who assess its worth
Yeah.
based on their own needs and expectations,
Mhm.
and then throw in supply and demand, and it becomes this intricate
It does.
web of factors influencing price.
Yeah, you've got it. And the book uses these really vivid terms
Okay.
to describe the lending landscape,
Okay.
easy money and tight money markets.
Okay.
Have you ever heard those phrases before?
Honestly, no, but they sound intriguing.
Okay.
Tell me more. What do they mean, and how do they impact real estate investment?
Well, easy money essentially means that interest rates are low.
Okay.
Loans are easier to get approved. There's more money flowing into the market.
Got it.
This can fuel demand, drive prices up as more buyers are able to compete for properties.
So it's like a party
Yeah.
where everyone's feeling generous and throwing money around. But
Yeah,
what about
yeah.
tight money? I'm guessing it's the opposite, a bit more of a subdued affair.
Exactly. Tight money describes a market where interest rates are higher, lenders are more cautious, and loans are harder to come by.
Got it.
This can make it more difficult for buyers to enter the market,
Right.
potentially cooling down demand and even leading to price drops.
That makes perfect sense.
Yeah.
It's like everyone's suddenly become a bit more frugal
Uh-huh.
and hesitant to spend.
Yeah.
It's fascinating how these broader economic forces,
Mhm.
easy money versus tight money,
Right.
can have such a direct impact on the real estate market.
It really highlights that interconnectedness of things.
Yeah.
And it's why savvy investors, they keep a close eye on these trends.
Right.
Knowing whether it's an easy money or a tight money market
Yeah.
can inform your investment decisions
Right.
from the types of properties you consider
Uh-huh.
to the financing strategies you employ.
So we've covered the why of investing in real estate.
We have.
The potential for solid returns,
Yeah.
the tangible nature of the asset,
Yeah.
the power of leverage. We've also touched on those inherent characteristics of real estate,
Uh-huh.
that fixity concept,
Yeah.
and how market dynamics like supply and demand,
Right.
the lending landscape,
Uh-huh.
play a crucial role.
Absolutely.
But the book really emphasizes the importance of market analysis
Yeah.
and feasibility studies before diving into any investment.
That's right.
But honestly, those terms can sound a bit intimidating.
Yeah.
What exactly do they entail?
That's where things get really interesting.
Okay.
Imagine you're presented with,
Yeah.
an exciting investment opportunity,
Yeah.
a charming apartment building
Okay.
in a trendy neighborhood.
Okay.
What's the first thing you'd want to investigate?
Well, I'd probably want to check out the neighborhood, see what's
Right.
going on,
Right.
get a feel for the vibe.
Yeah.
Is it a place where people want to live?
Yeah,
Are there businesses thriving? Is there a sense of community?
exactly. That's the essence of market analysis.
Huh.
Examining the economic climate of the community and the neighborhood.
Got it.
Are there jobs?
Uh-huh.
What are the mortgage lending trends in the area?
Yeah.
What are the going rental rates?
Right.
These are all clues that can tell you if the market is healthy,
Uh-huh.
if there's likely to be demand for your investment.
Right. It's like doing your homework
It is.
before making a big purchase.
Yeah.
You
Right.
wouldn't buy a car without researching its reliability,
No?
safety ratings, and you wouldn't invest in a property
Uh-huh.
without understanding the market forces at play.
Precisely.
Okay.
And beyond the overall economic climate, you'd want to zoom in
Yeah.
on the neighborhood itself.
Okay.
The book really emphasizes the importance of demographics.
Demographics. Okay, explain that one to me. What's so important
Yeah.
about understanding the people who live in a neighborhood?
It's all about anticipating future demand.
Okay.
We're talking about a neighborhood with lots of young families, suggesting a need for schools and family-friendly amenities.
Oh,
Or is it an area attracting young professionals,
right.
indicating a preference for trendy restaurants and nightlife?
Interesting.
Even population shifts matter. Is the neighborhood growing or shrinking?
Wow. I never realized how much depth there is to understanding a neighborhood.
It's like, yeah.
It's like becoming an amateur sociologist,
Yeah, it is.
studying the patterns of human behavior to predict future trends.
And don't forget about those locational attributes.
Okay.
The book has this incredible example of a drugstore chain battling a historic preservation committee over a parking lot.
Oh, wow.
It illustrates how seemingly small things,
Okay.
like transportation options,
Right.
proximity to amenities, and even the community's attitude toward development
Yeah.
can make or break an investment success.
So it's not just about finding a property in a thriving location.
Right.
It's about understanding the nuances of that location and how it aligns with your investment goals
Yes.
and the type of property you're considering.
And then there's the site itself.
Yeah. Okay.
The book dives into the importance of site analysis,
Uh-huh.
looking at everything from the physical characteristics of the land
Right.
to potential environmental concerns, and even, believe it or not, the smell.
Wait, the smell? Seriously?
Yeah.
What does that have to do with real estate investment?
It might sound funny,
Yeah.
but imagine buying a beautiful piece of land for development,
Yeah.
only to discover there's a lingering odor from a nearby factory.
Oh, right.
Those seemingly small details can have a huge impact on what you can actually do with a property.
Okay, that makes sense.
Yeah.
It's like buying a house with a hidden mold problem.
Yeah.
You might not notice it at first, but it can become a major headache down the road.
Exactly.
So site analysis is about uncovering those potential hidden issues
It is.
before you commit your money.
Precisely. So it's about getting a complete picture of the property and its surroundings
Right.
so you can make an informed decision.
Yeah.
And once you've assessed the market, the location, and the site,
Okay.
it's time to start talking numbers.
Okay, here's where things can get a bit daunting for me.
Yeah.
Financial analysis always seems like a whole different language.
Well, I know.
Are we talking complicated spreadsheets
Yeah.
and confusing formulas?
We are talking numbers,
Okay.
but don't worry.
Okay.
This book does a fantastic job
Yeah.
of demystifying those financial concepts.
Okay.
It breaks down things
Okay.
like interest calculations,
Huh?
loan amortization, and even that mysterious thing called discounted cash flows.
Yeah.
Don't let those terms scare you.
All right.
They're actually quite straightforward
Oh.
once you understand the basics.
All right. You've piqued my curiosity.
Okay,
Let's dive into those financial concepts in the next part of our deep dive.
great.
I'm ready to crunch some numbers. All right, I'm ready to tackle those financial concepts you mentioned. I have to admit, I'm a bit intimidated by terms like discounted cash flows. It sounds like something only Wall Street wizards understand.
I hear you. But trust me, the book explains these concepts in a way that makes sense, even for those of us who aren't financial whizzes. Let's start with interest calculations. You're probably familiar with the basic idea of interest. It's the cost of borrowing money.
Right, like when you take out a loan, you have to pay back not just the original amount you borrow, but also extra money in the form of interest.
Exactly. And there are different types of interest. Simple interest is calculated only on the principal amount you borrowed. Compound interest, on the other hand, is calculated on both the principal and any accumulated interest.
Okay, so with compound interest, the amount you owe grows faster because the interest is essentially earning interest itself. That's both cool and a little scary.
It is, and it highlights how time and interest rates can have a significant impact on your investment returns. The longer you hold an investment and the higher the interest rate, the more that compounding effect can work in your favor or against you if you're on the borrowing side.
So understanding interest calculations is crucial for both borrowing and investing. What about that other term you mentioned, loan amortization? That one always makes me think of complicated mortgage schedules.
Loan amortization is really just a fancy way of describing how a loan is paid back over time. Each payment you make typically includes both principal and interest. In the early years of a loan, a larger portion of your payment goes towards interest. As you make more payments, the balance shifts, and more of your money goes towards paying down the principal.
That's why it feels like you're barely making a dent in the principal balance in the early years of a mortgage. It's like running on a treadmill, you're putting in the effort, but you don't seem to be getting very far.
That's a great analogy. But eventually, you hit that tipping point where the principal payments start to accelerate, and you finally start seeing real progress.
So, understanding loan amortization is essential for managing your cash flow and planning for the long term. What about those mysterious discounted cash flows you mentioned? Is that where we need a calculator with extra buttons?
Well, a calculator definitely helps, but the concept itself is surprisingly intuitive. Discounted cash flow analysis is a way of projecting future cash flows from an investment and then discounting those future dollars back to their present value.
Okay, I'm following so far. We're basically trying to figure out what future income from a property is worth today, right? But why do we need to discount those future dollars? Isn't a dollar a dollar?
That's where the time value of money comes in. A dollar today is worth more than a dollar tomorrow because you can invest that dollar today and earn a return on it. So to make a fair comparison between money you receive in the future and money you have today, you need to discount those future dollars to account for the lost earning potential.
That makes sense. It's like factoring in the opportunity cost of waiting for that future income. If I could invest that money today and earn a certain return, then those future dollars are worth a bit less to me today.
Exactly. And discounted cash flow analysis helps you determine if the present value of those future cash flows justifies the cost of the investment. It's a powerful tool for evaluating real estate deals and comparing different investment opportunities.
All right, my head is starting to spin a bit with all these financial concepts, but I'm starting to get the gist of it. We've covered interest calculations, loan amortization, and discounted cash flows. What other financial tools do savvy real estate investors have in their arsenal?
Well, one of the most important tools is the operating statement.
Yeah.
It's basically a financial snapshot of a property showing its income and expenses over a specific period.
So it's like a profit and loss statement for a business, but tailored to real estate.
Exactly. It tells you how much money the property is generating, how much it's costing to operate, and ultimately whether it's profitable.
Okay, that makes sense. But I'm guessing it's more than just looking at the bottom line. What are the key things to look for when analyzing an operating statement?
You're right. It's about understanding the components of the statement. You have your scheduled gross income, which is the total potential rental income if all units were occupied. Then you subtract things like vacancy losses and credit losses to get your effective gross income.
Right, because even in a hot rental market, you're unlikely to have 100% occupancy all the time.
Exactly. And then you subtract your operating expenses, which include things like property taxes, insurance, maintenance, utilities, and property management fees.
So it's important to factor in all those costs, not just the mortgage payments, when evaluating the profitability of a property. What's left over after subtracting operating expenses from effective gross income is your net operating income, right?
You got it. Net operating income, or NOI, is a crucial metric for real estate investors. It tells you how much cash flow the property is generating before considering any debt service.
And speaking of debt service, that's another important factor to consider, right? How much of that net operating income is being eaten up by mortgage payments?
Absolutely. Debt service is the amount of money you need to pay each year to cover your mortgage principal and interest payments. And here's where the concept of leverage comes back into play.
Ah, I was wondering when we'd circle back to that. Remind me how leverage works again.
Remember, leverage is using borrowed money to amplify your returns, but it can also amplify your risks. The more you borrow, the higher your debt service payments, and the more of your net operating income will be eaten up by those payments.
So if I buy a property with a small down payment and a large mortgage, I'll have higher leverage, but also higher debt service payments. If the property performs well, I can benefit from those amplified returns. But if things go south, those high debt service payments could quickly become a burden.
Exactly. It's a delicate balancing act. That's why the book emphasizes the importance of understanding both positive and negative leverage. Positive leverage occurs when the return on your investment is higher than the interest rate on your loan. Negative leverage is the opposite. Your return is lower than your interest rate.
So positive leverage is what we're all aiming for, using borrowed money to boost our returns. But we need to be aware of the potential for negative leverage if our investment doesn't perform as expected. It's like a high-stakes game of financial chess.
It is. And savvy real estate investors carefully analyze the numbers to ensure they're playing the game to their advantage. They look at metrics like the loan-to-value ratio, which is the amount of your mortgage compared to the value of the property. A higher loan-to-value ratio means higher leverage, but also higher risk.
Okay, we've covered a lot of financial ground interest calculations, loan amortization, discounted cash flows, operating statements, net operating income, debt service, and leverage. My head is spinning a bit, but I'm starting to see how these concepts all fit together to give investors a comprehensive understanding of the financial health of a property. But what about those different types of real estate investments the book explores? I'm eager to dive into that smorgasbord of
Me
options.
too. That's where things get really fun.
Yeah.
We'll explore everything from the classic single-family home to more exotic options like office buildings, retail centers, and even those intriguing things called REITs. Let's take a deep breath and jump right in.
Okay, lead the way. I'm ready to discover the vast world of real estate investment opportunities. All right, let's dive into those different ways to invest in real estate. I'm ready to explore that smorgasbord of options you mentioned.
Well, the book starts with a familiar favorite, the single-family home,
Okay,
often seen as a stepping stone into real estate investment.
right.
And for good reason.
Yeah,
People understand houses. They've lived in them.
right.
They know how they work.
Totally. And there's something comforting about it.
Yeah.
You know, owning a piece of land with a house on it feels like a solid, tangible investment.
But what's fascinating is how the book distinguishes between owner-occupied homes
Okay.
and rental properties. It argues that only rental properties
Oh.
truly fit the definition of an investment generating income.
Wait, so living in your own home isn't considered an investment?
Not in the strict sense of generating ongoing income.
Okay.
While your home might appreciate in value over time,
Right.
you're not receiving regular cash flow from it,
Okay.
like you would with a rental property.
That makes sense.
Yeah.
It's like the difference between owning a valuable painting
Yeah.
and owning a vending machine that dispenses cash.
That's a great analogy.
The painting might be worth a lot,
Right.
but it's not putting money in your pocket every month.
Exactly. So if you're looking to generate income from real estate, rental properties are where it's at. And the book dives deep
Okay.
to one of the most popular options, multi-unit apartment buildings.
Those sound a bit more complex than managing a single-family rental.
They can be.
What are the key things to consider
Yeah.
when investing in an apartment building?
Well, the book stresses the importance of understanding those financial dynamics
Okay.
of multi-unit properties.
Yeah.
You're dealing with multiple tenants,
Right.
potentially higher operating costs, and the complexities of managing a larger property.
Yeah, it sounds like you need to be
You do.
a bit more of a business-minded investor to succeed with
Yeah.
apartment buildings.
It's crucial to understand metrics like net operating income,
Yeah,
cap rates, and cash return on investment.
got it.
The book even walks through a detailed case study
Okay.
analyzing the profitability of a 100-unit apartment complex.
Wow. 100 units. That's a lot of responsibility.
It is.
It sounds like investing in apartment buildings
Yeah.
is a whole different ballgame compared to single-family rentals.
It is, but it also offers the potential
Right.
for significant returns
Yeah,
if you know what you're doing.
for sure.
Now, beyond apartment buildings,
Yeah.
the book explores some other unique residential investment opportunities,
Oh, okay.
like cooperatives and condominiums.
Ah, yes. Co-ops and condos.
Yeah.
I've always been a bit confused about the difference.
You're not alone. Can you break it down for me?
Yeah, in a cooperative or co-op,
Okay.
you're actually buying shares in a corporation that owns the building.
Okay.
Those shares give you the right to occupy a specific unit within the building.
It's like owning a slice of the whole pie
Exactly.
rather than owning your individual piece outright.
Yes, and with that shared ownership
Yeah.
comes shared responsibility for the building's finances and maintenance.
Okay, got it.
Condominiums, on the other hand,
Yeah.
offer individual ownership
Okay.
of a specific unit within a larger building.
So with a condo, you own your own unit outright?
Uh,
You're responsible for its upkeep, but you also share ownership
right.
of common areas like
Yeah.
hallways,
Mhm.
elevators, and any shared amenities.
Precisely.
Yeah.
And the book highlights how condos have become increasingly popular,
Right?
extending beyond residential properties
Right.
to include office buildings, industrial parks, and even single-family homes within condo communities.
Wait, single-family homes within a condo community?
Yeah.
So it's like having your own house,
Yeah.
but with the added benefits of shared amenities,
Mm-hmm.
like a pool or a fitness center.
Exactly. It's a popular option for people who want the perks of condo living
Okay.
without sacrificing the privacy and space of a detached home.
That's pretty cool. It sounds like the world of residential real estate investment
It is.
is full of diverse options,
Uh.
catering to different lifestyles and investment goals.
And the book doesn't stop there.
Okay.
It also explores investing in land.
Land, okay. And land investment can be incredibly rewarding, but it's also considered the riskiest
Yeah.
type of real estate venture.
Got it.
It requires a deep understanding of zoning regulations,
Okay.
environmental concerns, and the long-term development potential
Uh-huh.
of a particular parcel of land.
So it's not just about finding a beautiful piece of land in a desirable location.
Right.
It's about understanding what you can actually do with that land, right?
Absolutely.
Oh.
The book stresses the importance of researching zoning laws,
Yeah.
environmental regulations,
Okay.
and even the community's attitude toward development.
Right.
It even delves into the complexities of financing land development,
Okay.
like using factoring and installment land contracts.
It sounds like investing in land requires a lot of upfront research and planning,
It does.
but it also offers that potential for creating something truly unique and valuable.
It is.
It's like being an artist with a blank canvas.
Yeah. And speaking of creating value, the book explores the world of commercial real estate.
All right.
Starting with those iconic skyscrapers.
Right.
We often associate with big cities, office buildings.
Ah, yes, office buildings. They
Yeah.
always seem so grand and impressive.
They are.
What are the key things to consider when investing in one?
Well, the book emphasizes the importance of understanding market dynamics,
Okay.
particularly the demand for different types of office space.
Okay.
Are you looking at a high-rise tower in a central business district
Uh-huh.
or a smaller office building in a suburban location?
Right, because the type of businesses
Right.
that might be interested in renting space
Right.
will vary depending on the location and type of building.
Exactly.
What else should investors consider?
Well, the book dives into the intricacies of office leases,
Okay.
from establishing rent schedules to negotiating clauses
Okay.
for subletting and even addressing the requirements of the Americans with Disabilities Act.
It's not just about collecting rent checks.
It's not.
It's about managing the complexities of a commercial lease and ensuring the property meets all legal requirements.
Exactly.
Okay.
And then there's the world of retail properties.
How's retail?
Everything from those familiar strip malls to
Yeah.
the bustling regional shopping centers
Yeah.
we often spend way too much time in.
I love exploring different shopping centers,
Yeah.
seeing that variety of stores and restaurants.
Yeah.
What are the key factors that drive the success of a retail property?
Well, the book highlights the importance of location,
Okay.
tenant mix,
Hmm.
and even the impact of e-commerce.
Right.
It's about creating a destination that attracts shoppers and provides a diverse range of goods and services.
Right, because a successful retail property needs to offer something
It does.
that online shopping can't replicate.
Right.
A unique experience,
Yeah,
a sense of community,
Yeah.
the convenience of having everything you need in one place.
exactly.
Okay.
And the book delves into the different types of retail properties.
Okay.
From neighborhood strip centers catering to daily needs,
Huh.
to regional malls offering a wider selection of department stores and entertainment options.
It sounds like investing in retail properties requires
It
a
does.
keen understanding of consumer behavior and the ability to anticipate trends
Yes,
in that ever-evolving world of retail.
it does.
Yeah.
And beyond office buildings and retail centers, the book explores
Okay.
a sector that's often overlooked,
Yeah.
but plays a crucial role in our economy: industrial real estate.
Industrial real estate. That's not something I've ever really thought about.
Okay.
What kind of properties fall into that category?
Think warehouses, distribution centers,
Mhm.
manufacturing plants, all those
Yeah.
spaces that are essential
Yeah.
for the production, storage, and transportation of goods.
Ah, that makes sense.
Right.
So investing in industrial real estate is about betting
It is.
on the backbone of our economy.
Yes.
What are the key things to consider in that sector?
Well, the book highlights factors like access to transportation networks,
Okay.
availability of utilities,
Uh,
and the size and configuration of industrial buildings
got it.
to meet the needs of different tenants.
Yeah, it sounds like location is just as crucial
It is.
for industrial properties as it is for residential and commercial real estate.
Absolutely. And the book also dives into the specialized leases
Okay.
and environmental regulations that often apply to industrial properties.
So it's a niche sector that requires specialized knowledge.
Yeah.
What about those more unconventional real estate investments the book explores?
Yeah.
I'm curious about things like manufactured home parks and mortgage securities.
Those are definitely outside the box.
Yeah.
Manufactured home parks can be a surprisingly lucrative investment,
Okay.
catering to a growing demographic
Right.
of retirees and budget-conscious homeowners.
I've always thought of manufactured homes as more of a housing option
Right.
than an investment opportunity. What makes them appealing from an investor's perspective?
The book highlights how well-managed manufactured home parks
Okay.
can generate steady cash flow,
Okay.
appreciate in value over time.
Right.
They often require less maintenance than traditional apartment buildings,
Interesting.
and they can benefit from economies of scale as you add more units.
Okay. That's interesting.
Yeah,
Sounds like a niche sector with its own unique set of dynamics.
it is.
What about those mortgage securities you mentioned?
Yeah, they could be a bit more complex.
Okay.
Mortgage securities are essentially bundles of mortgages
Okay.
that are pooled together and sold as investments.
Okay.
They offer investors a way to participate in the real estate market
Okay.
without owning physical property.
So instead of buying a house
Yeah.
or an apartment building,
Right.
you're investing in a pool of mortgages.
Exactly. And the returns on mortgage securities are tied to the performance
Okay.
of the underlying mortgages.
Got it.
It can be a way to diversify your real estate holdings,
Son?
potentially earn higher returns,
She right.
but it also comes with its own set of risks.
Okay, so we've covered a lot of ground.
We have.
From that familiar single-family home
Yeah.
to the more exotic world of mortgage securities.
Right.
It's clear that the world of real estate investment
It is.
offers a diverse range of options to suit different risk profiles and investment goals.
Yeah, absolutely.
But before we wrap up this
Mhm.
deep dive, I want to leave our listeners
Okay.
with a final thought to ponder.
Okay.
We've talked about all these different ways to invest in real estate,
Uh-huh.
the financial mechanics,
Yeah.
the importance of due diligence.
Yeah.
But ultimately, the success of any real estate venture
Right.
comes down to one crucial factor: your ability to make sound decisions.
Yeah.
That means staying informed about market trends,
Yeah.
understanding the legal and regulatory landscape, and most importantly,
Yeah.
trusting your gut. So as you continue to explore the world of real estate investment, remember, knowledge is power.
Yes, absolutely.
Do your research, seek out expert advice, and never be afraid to walk away from a deal
That's right.
that doesn't feel right.
Yeah. Good advice.
And with that, let's wrap up this real estate and deep dive. Thanks for joining us.
It's been a pleasure.